All right, so you get paid, you deposit your money into your bank account, and then what? Ever really think about what happens next? It can feel like your money just disappears into a big black box. Well, today, we're going to crack that box wide open and demystify exactly what banks do. So let's start with the big question right away. You put your money in the bank, you see the number go up on your phone app, great. But where does it actually go? We're going to follow the complete journey of that deposit, from your account through the whole financial system and all the way back. Okay, so to really understand this, we have to start with the absolute basics. What even is a bank? I know, it sounds super obvious, but this one simple idea is pretty much the foundation for our entire financial system. Let's break it down.
At its core, the banking system is really just a giant connector. It's the critical link between people who have some extra money saved up, we'll call them the savers, and people who need money for something, the borrowers. Its main job is just to keep that money moving smoothly through the economy.
Yeah, I love this analogy. A really easy way to think about a bank is as a matchmaker for money. Seriously. On one side, you've got savers who want a safe place for their cash, and on the other, you've got borrowers who need a loan to buy a house or maybe start a business. The bank's job is to introduce that. And here's how that whole matchmaking cycle works in 3 simple steps. First, you deposit your savings. Then, the bank takes a chunk of that money and lends it out to someone else. Finally, that borrower pays back the loan, but with a little extra on top. That extra bit is called interest. And trust me, that interest is the engine that makes this whole thing go. Which, brings us to the next logical question, right? If a bank is just moving money from one person to another, how is it a business? How does it actually make a profit? Let's dig into that next. Okay, so the number one way banks make money is through something called the interest spread. It's pretty simple, actually. Look at this. They charge people who borrow money a higher rate of interest, but they pay you, the saver, a lower rate of interest. That difference, that gap in the middle, that's the spread, and that's their profit. But that's not the whole story, of course. Banks also bring in money from all kinds of fees for different services. Things like a monthly fee to maintain your account, or a fee to wire money to someone, or even for changing your dollars into another currency for a trip. It all adds up. Now, with all this money flying around, you'd hope there are some rules, right? Well, there are, and this is hugely important. Banks aren't just allowed to do whatever they want. They're regulated by government agencies to make sure they're being safe and sound, and most importantly, to protect you and your money. So we've talked about the big picture, how banks work, but let's make this about you. How can you use all of this stuff? The best way to look at it is to think of all the services a bank offers as tools in your own personal financial toolkit. And here are some of the most common tools you're going to find in that kit. You've got your everyday stuff like savings and checking accounts. For longer-term savings, you have things like CDs. Need to make a big purchase? That's where loans and credit cards come in. And you might even see things like bonds. Every single one is designed for a specific financial job. Okay, so you've got the tools, but how do you know which one to pick, or how to use them safely? To help with that, let's wrap this up by going through some key questions that you should definitely be asking. And first up, this might be the single most important question you can ask about your bank accounts. It's all about your financial safety. What exactly is FDIC insurance? And this brings us right back to what we were talking about earlier, regulation. The FDIC is a government agency, and its insurance is basically a promise that your deposits are safe, up to a certain limit, even if something terrible happens and your bank fails. It's the ultimate safety net. All right, here's another one you've probably seen. You're looking to save some money, and you see ads for different certificates of deposit, or CDs, with all these different interest rates. Why is one so much higher than another? What's going on there? Well, this chart here really spells it out. As a general rule, the longer you're willing to commit your money, say for 5 years instead of just 1, the higher the interest rate the bank is usually willing to offer you. It's like they're rewarding you for that long-term commitment. Okay, so that brings up the flip side. What happens if you need that money early from your 5-year CD? Well, you're probably going to get hit with a penalty. But why? Why do they do that? It all comes back to the bank's business, right? That whole matchmaker thing. When you promise to leave your money for 5 years, the bank makes a plan to lend it out for about that long. If you pull your money out early, you mess up their plan. So the penalty is there to make you think twice. And that brings us to our last question. And this one is a big one. It's a real head scratcher for a lot of people. You might see something advertised as low risk, but it's not FDIC insured like your savings account. So, what does risk even mean if your money isn't guaranteed? And answering that question, well, that gets you to the heart of everything. It's about understanding the huge fundamental difference between saving and investing. Saving is about safety, keeping what you have. Investing is about taking a calculated risk for the chance to grow your money. And really getting that difference, that's not just some trivia. It's the first real step to building a solid financial future for yourself.